What up, squad? Welcome back to the YouTube channel. I haven't posted in a while and I can't wait to do this video with you guys. So this is a highly requested video. I've seen a lot of people asking for it, and it's basically people are getting confused with 10 pips a day. Is it enough? And I'm going to basically breaking down why it is enough and why pips can be measured in such different ways to people. You shouldn't be looking at the pips. You should be looking at the percentage gain on people's trades. Okay, it's not about the pips, because pips can be, highly scale to look like they've made a huge trade when actually they didn't really. Okay, so let's just go through this. So what is a pip? A pip is a measurement of how far price moves up or down from a certain point. That's all it is. And through different through different charts. So for example, over here I'll do GJ and gold. So from different charts, so gold over here, it's per dollar. So if you look at this point, so at the moment we're at 1777.72. If you go to 177778, so right around this zone, this will be 10 pips. Okay, so it's per dollar, it's 10 pips. Whereas on GJ, if we're at 149462, so around that area, we at 149562. That will be 10 pips. So right about here. Okay. So beautiful. Now we get this into tact. It always differs on the different pairs. Normally, like gold is what for $1 is 10 pips, and then different for other pairs. But anyway, that's not what the kind of scale over here that we're looking at. We don't really mind about that. It's about the measurement of pips. So pips can be measured in so much different ways. It depends on the percentage risk and the stop loss. Okay, this is the main thing we're going to be focusing on today. So I'm going to be doing an example right about now about how a trade would work, and how it's basically so different. It really depends on how much you're risking. So let me just do an example over here. Let me just take some text. So imagine we have an £1,000 account. Most people risk, so we risk 1% per trade on 10 pips or whatever. So we're just going to do risking 1% per trade, and let's do an example over here. So this is great actually. We've got a closure right about here, and we should be continuing up to fill up this range. Beautiful. Okay, so let's just make kind of a trade over here and just do an example. So we've got a closure above. I enter on the flip when we make the low wick. Now for me, if I was in this trade, my stop loss would be below the previous 30-minute candle, which is 10 pips. Okay, so if I have an £1,000 account, I'm risking 1%. So if price comes down over here and hits my stop loss, I'm going to be losing 1%. That's £10. Therefore I can use a 0.1 lot. So for me here I can use a 0.1 lot. Okay, so that means if price does come to my TP, which looks like I'll be doing over here, I'll be making 1% of my account. Okay, but if price comes back over here, I'll be losing 1%. Very, very simple. Okay, simple concept. Now let's do an example of someone who maybe trades a bit higher pip count. They have a bigger stop loss. So let's just do another example. So remember this example over here. Okay, so if you come to this point here, I'll be making 1%. If you come here, I'll be losing 1%. Very, very simple on a £1,000 account. You can do this at any account size. All makes sense in 1 second. So imagine if I do kind of swing trades and I'm still looking for buys over here. It's still the exact same trade, but my stop loss I want actually below all of this kind of traffic over here. So let's just measure this zone. So now we're looking at a 25 pip stop loss around about here. So 25 pips. Okay. Okay, beautiful. Now obviously I say 10 pips a day because 10 pips is kind of where we see price retracing at some points. But for example, this swing trader over here has a 25 pip stop and is looking to maybe exceed these highs, etc. So maybe at this point over here. Let's see how far this is. So this is 16 pips and then about 25 pips. This is a good example. So I'm going to move my TP for 25 pips over here, right at these highs. Okay. Now, as I said before, there are 10 pips over here. I'll be making 1%. Now let's do it for this example. So let's just say we also have a £1,000 account over here, and we're more swing traders. Not swing traders, but kind of you're happy to hold a bigger stop loss. So we also risk 1% on this account over here. But now, as you can see over here, guys, we can't use a 0.1 lot, because if we had a 0.1 lot over here, if price came back to our stop loss, we would be losing 2.5%, which is way too much for one trade, okay? We'll be losing 2.5% on this trade. So we have to change the lot size. We have to decrease the lot size if the stop loss is bigger. So at this point, let's look at the lot size. We had 0.1 lots before. Now we have 25 pips stop loss. Use some basic maths here. You should be able to do this. I've just done it in my head. So it's 0.04 lot we can be using. So if you use a 0.04 lot now, at this point, then if you come back down here, now we are going to hit 1%, which is beautiful. So now we're back at 1% loss, which is beautiful. So now exactly the same risk parameters, but one of them has a 10 pip stop loss. So let's just write this here. One has a 10 pip stop. Okay. And now the other has a 25 pip stop. But they are both risking the same, and they'll both win and lose the same. So for example, over here, we said if price hits our TP right at this point, so when do we get in? 443, so right about this area over here, this will be TP1 for our first example, and TP2, and TP1 for our other example will be up here. Now as you can see, the price in the first example only has to get to here to then close profits and make 1%. The other one has to push all the way up and exceed and hit 25 pips. But people will happily say, you know, oh, I just made 25 pips. So for example, okay, let's just try to measure. So for example, I wanted to get my zoom out, but anyway, I didn't have it open. For example, if this comes up over here and hits 25 pips, this account over here could say on Instagram, oh, I just made 25 pips profit, let's go, you know. But actually, all they did was do the 1%, which is beautiful. Exactly, they only actually did 1%. Okay, beautiful. So this is the second account. Now, if we do this first example and we hit it over here and we hit take profit right at this point, okay, we also hit take profit. We made 10 pips. But we also got a 1% gain. Now, if you look at Instagram and kind of stuff, which one looks better to you? Which one looks better? Is it this one or this one? Well, on paper, if you didn't get what I'm talking about here, you would say, well, the second one, he's made 25 pips. The only one only made is 10 pips, you know, not the best. Not 10%, 10 pips here. You'd pick the second one. When actually the case is that they're both the same. The only difference is someone had a bigger stop loss, therefore they had to risk less. This is why we run a 0.04 lot. And the first one had a bigger lot size because they could risk less because they could risk more because their stop loss is tighter. And this is the only difference between pips. So now you can put this in any terminology, any account, and start seeing, you know, people saying, oh, I made 100 pips. Now, for me, we'll do another example over here on gold probably. But for example, if this candle over here pushes up and the first example over here doesn't close profits, it puts pulley stops to break even, and then we run all the way to over the tops over here, then this account now, let's just change this, has made 25, for example, if they didn't close any and they held it on, has made 25 pips. So therefore, they have made 2.5%, okay? Because their lot size is bigger, but their stop loss was at 10 pips at 1%. So now this trade hitting 25 pips and this trade hitting 25 pips, the top one has made 2.5% and the bottom one has only made 1% because their stop loss was bigger. Okay, so this is all it's about. So now, for example, if you start seeing people on gold, for example, let's go over to gold over here. If you see gold and you see TED and stuff, for example, yesterday, some really solid trades at this point. A lot of people got into it. I got into them yesterday. So let's just take an example. I got in when we exceeded this high on the lower wick over here. And the stop loss was on the lower wick. So you can see here, let's do a measurement. Okay, I risk 20 pips. Okay, so 20 pips. I risk 20 pips at 1%. Okay, oh shit. At 1%, beautiful. 20 pips at 1%. Okay, so if price comes back to this low over here, I'm going to lose 1%. Now I close my positions around about what was it? Let's have a look at the 15-minute over here. Let's just move around. So I close profits right about this point over here at 1773. So this moved up. Sorry, not 773. What am I on about? This candle high. So 171.3. So let's have a look over here. Let's measure this. So now we've just gained a 30 pips over here. So now I took profits over here and I actually made 30 pips. So my risk 20%, I made 30 pips. Therefore, I gained 1.5%. Beautiful. Beautiful trade, gorgeous. Now, if someone over here held this and it came all the way up over here, and didn't hit your stop loss for some reason, or you had a bit higher up, or waited for this wick and then to continue, and runs all the way to the top, even though you only had a 20 pip stop over here and you made 100 pips, then you have done very, very well. You've risked 1% on a 20 pip stop loss, and it ran 100 pips. That's 5 times your risk. Therefore, you've just made 50%. Sorry, 5%. There we go. Beautiful. 5%. Gorgeous. Now, this trade could be exactly the same as someone who also did this trade, but their stop loss, let's have a look here, their stop loss was down here. Let's just do, for example, over here. Okay? Maybe swing trading it. Okay, they wanted a bit more room. That's completely fine. Now look, let's just do an example over here. So let's just see their stop loss is at 50 pips. Okay, so 50 pips. Now if price pushes up over here and they close right at this point, they would have made 30 pips over here, but their risk was 50%, so 50 pips. So their lot size is a lot smaller, and they actually didn't even make 1% on this trade. Okay, someone who held at 50 pips stop loss but ran 100 pips. Let's just say it did run 100 pips at this point, so 68, 78. So this is the first example. So if you had a 20 pip stop and it ran 100 pips, you made 5%. Someone else could also have this trade. They risked 50 pips at 1%, but it ran 100 pips just like before. You would have made 2%. Now, on paper, on an Instagram and stuff, this looks like the same. Someone's made 100 pips. Someone's made 100 pips. One person risked 20 pips. Some other person risked 50 pips. They made a lot more money. They made double, 2.5 times more money than this person did, or more percentage of the account. So even though it looks like the same trade, people get confused with the pip. It's all about your stop loss and how much you risk, because this one over here would have had to have had a much lower lot size compared to this one. Okay, so very, very simple. I've done 2 examples here. It should make sense to you guys. Very, very easy and simple thing. So going back to our little presentation over here, I'll move myself up. So just to the examples. So remember, you're focusing on the percentage gain. Okay, so when people are saying I made 100 pips, okay, well, did you make 100 pips? Amazing. Where was your stop loss? Was your stop loss 100 pips? Because if someone took a gold trade and had an 100 pip stop and made 100 pips, they only made 1%. Just like I made a trade with a 10 pip stop loss and it hit my 10 pips profit. Okay, it's exactly the same. Just someone had a bigger stop loss. So there you go. So this is why you can make 10 pips a day, because if you take trades, for example, GJI took a lovely sell today. Let's just move all this stuff. I took a lovely sell at this point and I made 1%. I only risked 1.4%, but anyway, I made 1.4%. That is exactly the same as someone, for example, taking a short at probably these highs, maybe just rejecting, with a, let's just see over here, with a, let's just move this up, 542, let's get it to 105.2. So right about here. This is exactly the same as someone taking a 50 pip stop loss and making a 50 pip gain. Okay, so like for example here. So if price got to this zone over here, that is exactly the same as me hitting 10 pips. The only, oh sorry, you guys can't see this. 1 second, let me move it over here. There we go. So exactly like this, 50%, 50 pip stop loss and a 50 pip gain down here. That's exactly the same as me doing a 10 pip stop loss and a 10 pip gain if we're risking the same. So for example, if they risk 1% here, I risk 1% at 10 pips. So I hope that made sense, guys. And obviously, because I took this trade over here, I made 1%. And if I take another one at NY and make another 1%, I made 2%. That's exactly like someone making So that's 2% a day. That's like someone having a 50 pip stop loss and gaining 100 pips. But one of them looks a lot better on Instagram, saying they've made 100 pips than me just making 10 pips. But actually, it's the percentage gain. So I hope that makes sense, guys. And yeah, if you guys are new to this, new to the channel, we're trying to hit 1,000 subscribers. We are very, very close to hitting it, and I really, really, really can't wait. So if you guys are new here, make sure to drop a like, subscribe, and I'll see you guys in the next one. Peace out, guys.